welcome in our next guest on the show. Indranil Sengupta of CLSA is now with us, economics and head of research. Indranil, thanks so much for taking out time for us. Could you just talk to us about the recent oil price shock which has come in? And in the recent report, you say this time it's much more manageable versus earlier times. Why so?
So I think that, the geopolitical risks, especially the oil shock, is getting overdone for the Indian economy. If you see, we take a scenario where oil, let's say, goes to 150 to 200 dollars a barrel for 2 months because of the war that is going on, and then subsides because once the war is over, or actually in the next 10, 15 days, the market will also begin to look at Fed tightening. We also assume that you get $20 billion of FPI outflows, for 5 billion of which has already happened because of the extreme risk aversion that we are seeing. So then you see, you are effectively looking at an FX outflow of 30 to 50 billion dollars at a time when the RBI has sufficient FX reserves. So the RBI's FX reserves are around $680 billion, including forwards. We think that 600 billion is adequate. So the RBI has $80 billion of excess FX reserves with which it can easily fund this outflow of 30 to 50 billion dollars that might take place.
Okay,
So
so
then,
perhaps.
from that perspective, whenever you had an oil shock earlier, you didn't have FX reserves, you had to go to the IMF and stuff like that. We are in a far better situation now.
Okay, so we are much better placed as far as the FX reserves is concerned, and the worst as far as the FPI outflows is not done. That's the word coming in. But what do you think this does to the rupee as well as the bond yields? Because we are seeing that it is now trending towards the 7% mark.
So, first to talk of the rupee, we think the rupee should be in the 73 to 76.50 range for the year. Right now, given the uncertainty all around, it is for the RBI to set, a Lakshman Rekha, if you like, for the rupee, which currently seems to be around 77. Because obviously this is a central bank with very high FX reserves, and it has to choose where it will draw the line, where it will defend the rupee, and so on. So that's point number one. Number two, we always thought that yields would go to 7%, irrespective of the war, much long before the war, because you have a very high fiscal deficit, which means that there's a massive GSEC excess supply of GSECs in the market, and the RBI should be hiking at least 100 basis points next year. So we think that bond yields should be around 7% now and 7.5% in the coming year, irrespective of the war.
Indranil, when we just talk about holistic approach of earlier episodes. So taper tantrum, of course, was the one which really saw that the money was really pulled out of system. We've seen earlier cases where crude oil prices have gone ahead and gone up. All of them coming together. But you think that markets so far have taken it? Investors so far have taken it. Maturely. Indian markets have broadly outperformed the fall versus some of the others. You think all of the factors that you said about reserves, the changes that have happened, the rate hike that I expected are all playing to that sort of momentum in India?
Yeah, so I think the best defense India has against global contagion now is that it has high FX reserves, which anchors the rupee. If you go back, to previous episodes when, we did not have sufficient FX reserves between, let's say, 2010 to 2020, you often saw, the rupee depreciating 10%, 20% even. So that is something that's a thing of the past, and that's helping, to some extent right now, and should continue to provide a shield for the Indian economy right now.
Right. First time going into December 2021, we really saw all economist reports talking about a structural recovery across India, maybe not led by consumption, but at least by assets and investments into capex. Do you think with oil prices moving the way they are, it could take a backseat because the consumption really takes a hit?
So we never talked of a structural recovery. We were always in the camp that there is a shallow recovery, demand is an issue. And because demand is an issue, capex also will take time to recover. So we are looking at 7.4% GDP growth rate next year. And I think that, uh, if you look at the impact on inflation, for example, right now oil prices are benchmarked to $85 a barrel. So even if oil prices go up to 100 on an average basis for the year, you're talking of 50, 60 basis points of inflation, additional inflation. Our forecast of inflation for the entire year is 4.7%. You go to somewhere around 5.3 to 5.5%, which is not that excessive. Again, like I said, that yields probably go up to 7.5%. Again, there is no great reason for the RBI to step up tightening because of oil going up. So I don't see, the higher oil price affecting growth. Growth has other issues. The fact that consumption demand is weak, the fact that there is excess capacity because of which investment is not happening, and so on.
You are saying that a higher crude price might not impact growth, but the question is, will it impact the margins of the companies? And I would ask you to wear the hat of the head of research and tell us that, are you expecting more downgrades to happen in the coming time? Do you think the street has already factored in the worst as far as margin compression is concerned on account of the commodity prices?
So I think we have been factoring in margin compression, not just because of oil prices, but also because of what is happening in the palm oil market as well for a number of consumer companies, what is happening in, the other commodity prices as well. But, if you look at what is happening right now in the commodity space, that's being driven by war. So in a way, I would say that, we would think that if once the war is over, a lot of this will abate and the Fed tightening starts. So you have, uh, I would think that, commodity prices would be lower, let's say 6 months to 1 year from now than higher.
Since you just touched upon Fed tightening, what's your take regarding the impending Fed meeting, which is coming up in the next week? What is your expectation and house view?
So we are looking at a 25 basis point hike
Sure.
by the Fed, yeah, and 6 hikes this year in all.
Thank you so much for joining us with that perspective as far as Indian market is concerned and what to expect from RBI as well as US Fed going forward. Appreciate your time and joining us on the show today.